know that moment when someone asks where your business is heading in 3 years and your pulse quickens? Or you've been putting off that strategic planning session for months because you don't actually know what to plan for. Or maybe you're lying awake at 2 a.m. wondering why, if you're working so hard, it's just not satisfying anymore. At its core, this will feel like confusion about what you're actually building toward, and guilt that you should have figured this out by now. If any of this sounds familiar, it's time to think about strategy. Lewis Carroll wrote something in Alice in Wonderland that puts a useful lens on this. "Would you tell me, please, which way I ought to go from here?" asked Alice of the Cheshire Cat. "That depends a good deal on where you want to get to," said the cat. "I don't much care where," said Alice. "Then it does not matter which way you go," said the cat. Carroll knew something that escapes a lot of people in business. You can't choose a path until you know the destination. The good news here, though, is that this isn't a personal failing. It's a systemic founder problem. We all do it. We're running hard down paths we may never have clearly chosen or recently reaffirmed as the correct path. Too rarely do we stop to ask ourselves, what do I actually want from this? What returns am I hoping for? And what am I willing to sacrifice to get them? So let me ask you directly, are you Alice, working hard, asking which way to go, but you've never actually figured out where you want to get to? Frankly, I see this all the time working with founders, and I've been there myself. There are these predictable points where businesses stall, around $1 million in revenue, around 3 million, and around 10 million. They're very different plateaus, but the same underlying issues. Now, if you're sitting there thinking, I'm not even at 500,000 yet, or I'm already at 25 million, please don't tune out. The scale doesn't really matter. It's the principle that does. In my experience, there's one of two things happening. Sometimes it's the Peter principle. You've grown the business to the edge of your current capability, and you're not developing the new skills fast enough to match what the business needs next. And you're probably not hiring the people who can fill those gaps either. Putting aside Peter, more often than not, it's actually something else entirely. And it's so simple, we often mistake it for being easy. Hi, it's Josh. Thanks for listening to the show. Most founders don't build just one thing. They build many. The company, the team, and the legacy. JB Ware in New Zealand understands that your exit isn't an ending. It's the bridge to what you build next. Whether that's backing the next generation, funding what matters, or creating impact that compounds across decades. The best exits aren't measured in commas alone. They're measured in what those commas enable. 2 Commas is proudly partnered with JB Ware, building wealth that works as hard as you did. You haven't actually figured out what you want from the business in the first place. Yes, I have. I want to make loads of money. If that's what just went through your head, you're kind of missing my point. Of course, business needs to make a profit. It needs to provide financial returns. But business is far more complicated and nuanced than just making money. When you don't know what you actually want, it shows up everywhere. You can't hire great people, or you hire them and they leave 6 months later because they can't figure out what it is that you're building towards. It's hard to blame them when you haven't figured it out yourself. Perhaps you're chronically exhausted but can't pinpoint what's really wrong, working harder than ever, and the business just isn't responding. Now, you've probably tried things, EOS, scaling up, maybe other frameworks. They're good frameworks, but they're not a substitute for the foundational work, which is what this discussion is all about. Now, if any of this sounds familiar, you're not alone, and there's nothing wrong with you. These aren't random, unrelated problems. They're symptoms of the same root cause. When I sit down with founders who are stuck, They think strategy is growth plans, market analysis, competitive positioning. Now that's the tactics layer, which isn't bad, but strategy starts way before any of that. It all starts with a question almost nobody asks themselves, honestly. What do I actually want from this business? Not what investors want, not what looks impressive on LinkedIn, and not what you think you should want. And when you dig into that question, like really dig, it breaks down into two distinct components. What returns am I optimizing for? And what am I willing to sacrifice to get them? Simple questions, but almost nobody answers them cleanly. Because they're hard. They force you to confront trade-offs that you probably haven't considered until just now. The returns you want might be a big exit number, or it might be protecting your time and autonomy, or building something that outlasts you. These aren't the same game, and they don't require the same sacrifices. Every choice has consequences. Some are reversible, others define you. Jeff Bezos separates decisions into two types. Type 1 decisions are one-way doors. Walk through and the door closes behind you. Type 2 decisions are two-way doors. Try it, come back through again if it doesn't work out. To bring this to life, I have a friend who suffered a chronic ice climbing accident some years ago. He severely damaged his leg. Whilst he was unconscious, the surgeons wanted to amputate just above the knee. His family insisted that if he did this, once he regained consciousness, my friend would beat the surgeon to a bloody pulp if they went ahead without consent. The surgeon was adamant. He'd never walk properly on that leg again. Better to take it off now. When he came to, my friend made the type 1 decision to keep it. Now, he spent the next 2 years in the most agonizing rehabilitation program that you can imagine. But when I met him, he'd just completed his first marathon on his own legs. That's a type 1 decision. Once the leg's gone, it's gone. You can't reverse it. So the problem that I see, a lot of founders treat type 1 decisions like type 2 decisions. Choosing your business partner, type 1. Merging with or acquiring another business, type 1. Taking on investors, type 1. These aren't easily reversible. Once you've partnered with someone, you can't simply unpartner with them. Once you've integrated two businesses, you can't cleanly separate them. And once you've raised venture capital, you can't unraise it. But probably the biggest type 1 decision of all, it's what you're actually optimizing for. Those two questions about returns and sacrifice. In a founder-led business where your name is on the door and your reputation is the brand, that decision determines kind of everything. Naturally, your sense of self gets wrapped up in whether this thing succeeds or whether it fails. Now, this doesn't mean you're locked into one path forever. Your age, your stage, your energy, your long-term desires, these change. What you want at 35 might be different from what you want at 50. That's perfectly normal. But you need to know what you want now for this stage, for this version of your life, and for as far as you're able to see into the future. Really minimum 3, but preferably 5, and maybe even 10 years. I'd suggest that if you get this foundational question wrong, you may not realize it until years down the path, and by then you've probably built something that doesn't serve you. You're feeling unfulfilled, burnt out, and miserable. Here's what I've discovered working with hundreds of founders over the years. When you get honest about these two questions, what returns you want, what sacrifices you're willing to make, patterns emerge. These are predictable patterns. 4 of them, I reckon, actually. I like patterns. They're useful. They let you step back from your very personal, very specific situation and see the shape of what you're dealing with. They simplify the complex, and they give you language for something that you may have been feeling but couldn't quite articulate. When you can see the pattern you're in, you can make better decisions about where you're heading. These 4 patterns sit on 2 dimensions. A quadrant, simple graph, 2 lines crossing in the middle, and they create 4 boxes at the extremes. On the vertical axis, That's what you're optimizing for. The magnitude of return that you want from the business. Are you looking for modest returns that fund a great lifestyle? Or are you swinging for the fences, building towards a major exit? There's two extremes, but there's many, many points on that continuum. On the horizontal axis, going left to right, that's what you're willing to give, the depth of sacrifice you'll accept to get these returns. How much of your time, your health, your family life, and your autonomy are you prepared to trade for those returns? The most common thing that founders say to me on my podcast is that if they had known how hard it was going to be before they started, they may not have done it in the first place. That right there, that's sacrifice. So when you plot founders on these two dimensions, return ambition versus sacrifice tolerance, four distinct quadrants emerge, four patterns. The first pattern, the freedom founder, that's the bottom left quadrant. Low to medium returns, low sacrifice, but high autonomy return, high time freedom return. They're protecting their ability to choose how they spend their days, and they're unwilling to sacrifice their time, their identity, their personal freedom just for scale. This is for someone who's built a business to serve their life, not the other way round. I know a marketing agency owner a few years back who had a growth spurt, 200, 300% year-on-year growth. It was exciting stuff. Except it wasn't exciting for long. To handle the growth, they needed to build a management team, which meant they got pulled out of client work, the part that they actually loved, and spent their day dealing with HR issues, performance management, and some internal politics. They were miserable. So they made a choice. They tightened their ideal customer profile, reduced headcount by 50%. They went back to a smaller, more focused team. Revenue actually dropped, obviously, a services company. Profit margins, however, they went up, and client satisfaction also went up. And the founder, they got their life back. That's a freedom founder, someone who looked at their growth path, did the math on what it would cost them, and said, no thanks. Now, from the outside, this might look like leaving money on the table, like a lack of ambition. But on the inside, they've optimized for a different set of returns. This isn't a lack of ambition. It's clarity about what really matters. The freedom founder has figured out that once you've got enough money coming in to live well, more money doesn't necessarily mean a better life. But freedom of time and choice, that's the real goal. Here's the risk though. If you're a freedom founder, but you're still telling yourself a scalar story, still measuring yourself against people building towards exits, you're going to be perpetually disappointed. The misalignment will eat you. And we'll come back to that. Remember, none of these patterns is better than the others. They're just different optimization problems. Same two questions. What returns do you want? And what are you willing to sacrifice? Different answers and a different playbook. Let's talk about the second pattern. The builder. Bottom right quadrant. High ambition and low sacrifice willingness. This is the founder who dreams big. $50 million in revenue, significant market share, real impact, but isn't willing to make the trades that typically come with that level of growth. They don't want to take on investors and dilute their ownership. They don't want to hand over control to a professional management team. They want to build something substantial whilst maintaining the control and autonomy of a simpler operation. I see this most at the $5 to $10 million revenue mark. The business has grown past what one person can manage, but the founder hasn't yet changed how they operate. You're running a business that needs proper systems and leadership, but you're still making every major decision yourself. You're actually the bottleneck. Every fire that breaks out, you're kind of the one putting it out. I once worked with a founder at $7 million of revenue who'd previously tried to hire senior people 3 times in 2 years. All 3 of them failed. He kept thinking that the next hire would fix it. The root of the problem, however, was that he'd hired people without clear measures, incentives, or accountability. They couldn't make the decisions without checking with him first. He never gave clear authority. To him, taking on capital felt like losing control, and bringing in a proper COO felt like admitting he couldn't do it himself. So he stayed stuck. But when we designed a very clear org chart, who owns what, clear decision rights, proper accountabilities and measures, the business could actually function without him being the bottleneck. Once he accepted he was a builder, not a scaler, he could consciously choose the returns he was optimizing for and the sacrifices he would and wouldn't make. He got his builder outcome, growth on his terms without giving up control. When a builder knows they're a builder and builds the right structure, they can stay capital efficient. They build exactly what they want. They keep optionality, but if they don't know, they just wonder why they can't break through. The third pattern is the scaler. Top right quadrant, high return, high sacrifice. This is the founder who's all in for maximum financial return, whether that's maximizing profits or building towards a big exit. They might take on investors, they'll definitely build a full leadership team, and they'll probably have to give up day-to-day control. They'll work probably whatever hours it takes, and they're willing to trade time, maybe their health, definitely some autonomy, most things, for the chance at a significant financial outcome. Matt ran a successful global HR search business for 10 years. Great business, very profitable, operating across multiple regions. Then he decided it might be time for a change. A potential buyer indicated interest. But to be interested in actually buying the asset and the business, they wanted to see more of certain things and less of others. So Matt spent the next 2 years refactoring and refocusing the business to make it more attractive. It worked. He doubled the valuation in that time frame, in 2 years. Afterwards, however, he saw it very clearly. And in his words, it nearly killed him. His health and relationships suffered severely. Running multiple time zones, implementing initiative after initiative, rebuilding whilst still operating. The sacrifice for Matt was real. But if you're actually a freedom founder or builder telling yourself a scalar story, this level of sacrifice will feel like self-betrayal, not just hard work. The scalar path can deliver the outcomes, significant exits, life-changing money, the ability to do it again or fund the next chapter on your terms. But it needs to be more than just willingness to sacrifice. It needs governance, strategic discipline, clear decision-making frameworks. Without that, you'll likely run hard towards burnout. With it, you give yourself a real shot at getting the outcome you're chasing without destroying yourself in the process. Let's talk about the fourth and last pattern, the steward. Top left quadrant, medium to high returns and medium to high sacrifice, but optimizing for legacy. This is the founder building something that outlasts them. On the two questions, what returns, what sacrifice, the steward is optimizing for legacy and continuity of returns and is willing to sacrifice speed and sometimes peak valuation to preserve those things. They're not chasing the fastest exit. They're not protecting their time above all else. They're playing the infinite game, building for enduring value and for impact that continues after they're gone. Paul Newman was a hugely successful actor of the last century. And post-acting, he built a spaghetti sauce company called Newman's Own. This became a hugely successful food business. And over the years, he was approached numerous times, and he could have sold the business for hundreds of millions of dollars. Instead, he structured it so that 100% of the profits go to charity. He permanently traded personal upside for a structure that kept funding causes he cares about. After his death, the company continues operating exactly this way. This is legacy over liquidity. But you don't need to be Paul Newman to be a steward. I know a founder who 7 years after building his consulting business got approached to sell. It was a good offer and a clean exit. Instead, he made the decision to appoint a super capable general manager and only sold a small part of the business. He kept the parts that mattered most to him and his people. Growth has been modest since then, but it's remained very profitable. And for him, he's not hands-on anymore. He built something that runs without him while staying true to what he wanted it to be. That's the steward trade-off. He gave up the maximum exit number for control over how the business continues. I see steward decisions most often at life stage transitions. Founders in their 50s, maybe 60s, thinking about succession. Second generation family businesses deciding whether to sell or to continue. Founders who have built something meaningful and don't just want to hand it to the highest bidder. They'll make significant sacrifices, but different ones than the scaler. They'll invest in culture, in developing people, in building systems that work without them. They'll give up daily control, but they care deeply about who they hand that control to. When done consciously, stewards build businesses with deep roots and loyal followings. They attract people who want to be part of something bigger than a paycheck. When done unconsciously, they can end up trapped, sacrificing like a scaler but without the exit, clinging to control like a builder but without the freedom. So there's your 4 patterns: freedom founder, builder, scaler, and steward. All have different returns and different sacrifices to make. In reality, these are different games entirely, and none of them is wrong. They're just different. Remember those symptoms we talked about at the start? The plateau at $3 million or $10 million, the exhaustion, the staff who keep leaving because they can't figure out exactly what you're building towards. At its core, that's misalignment. Your strategy doesn't match your pattern. You're a freedom founder trying to run a scalar playbook, or you've got builder sacrifice tolerance, but scalar ambitions. You can feel it, but you might not be able to name it. And you know something's not quite right. So, let's fix this. Your pattern is the foundation for everything that follows. You can't build strategy until you know your pattern. You can't hire the right people. You can't make smart decisions about capital or growth or succession, because all of those decisions depend on knowing what game you're actually playing. So before you do anything else, before you build your strategy, before you hire your next leadership role, figure out your pattern. What returns are you optimizing for, and what are you willing to sacrifice to get them? Here's how to start. Set aside 30 minutes. Grab a notebook. No one else's opinion. No podcasts, maybe mine, playing in the background. Just you and these 2 questions. Write down what you actually want. Not what you think you should want, not what would impress people, what you do want. Then write down what you're genuinely willing to trade it for. Your time, your health, your autonomy, maybe your relationships. And be honest, your pattern will start to emerge. But I'll be straight with you. This is genuinely difficult work to do alone. You can't read the label from inside the jar, which is where the next part of this framework becomes critical. Now, as mentioned, maybe you've already tried to fix this. You've read the books, implemented EOS, or scaling up, or some other framework, which means hiring the consultants and doing all the exercise. And yet, you're still stuck. The good news is there's a reason for that. Dunning-Kruger is the bias where the less we know, the more we think we do know. You feel confident precisely because you can't see what you're missing. That's not a moral failing. It's just how our brains work. And we all do this with strategy. We grab a framework that worked for someone else and assume it will work for us. I knew a founder who spent a year with a strategy implementer. They kept struggling to get it to work, tried and failed multiple times. They started thinking they were the problem, that they were broken. They weren't broken. The framework was just built for a scaler. They were a builder. So every recommendation pushed them towards giving up control, bringing in outside leadership, and raising capital. Everything the framework assumed they wanted. But as neither they nor the implementer checked, it turns out they didn't want that. So these frameworks, they're not wrong. They're just not anchored in who you actually are and what you really want. That's why they keep failing you. The work we're doing here flips the order. Pattern first, then BHAG, then purpose, then frameworks. These tools become multipliers after you've decided what game that you're playing. And they're often designed for founder-led businesses where your personal returns and sacrifices are part of the equation, not an afterthought. So once you know your pattern, you'll need some direction. Jim Collins is a management researcher who studied thousands of companies over time, trying to figure out what makes some endure while others fade. One of the most powerful patterns he found in enduring companies was what he called a big, hairy, audacious goal. He loved the term so much that he trademarked it, BHAG. It's a clear, unifying, inspirational goal, typically 10 to 30 years out, although for founder-led businesses, we can often adapt that time frame. Companies with a clear BHAG make better decisions. They stay focused when everything around them is chaos. The critical piece most people miss, though, with a BHAG is that it must align with your pattern. A Freedom Founder's BHAG is oriented around autonomy and lifestyle. A Scaler's is oriented around maximum financial return. A Steward's, legacy and continuity. And a Builder's might target substantial scale but on their own terms, big but within their sacrifice limits. It's the same concept, just applied differently depending on who you are and what you want. When your BHAG ignores your pattern, you've just created another source of misalignment. Even if it's textbook perfect, even if it looks great on paper, if it doesn't match who you actually are, it's pushing you towards burnout instead of clarity. Think of your BHAG as your North Star. The North Star has guided travellers for thousands of years, sailors navigating oceans, escaped slaves following it to freedom. It's a constant, reliable indicator. It's always there in the sky. But it doesn't tell you how to get where you're going. It tells you which direction to move. Your BHAG works the same way. It's not a detailed plan. It's not your strategy. It's the point on the horizon that helps you make decisions when you're lost. Should we take on this client? Does it move us closer to the star or further away? Should we hire this person? Do they help us get there or pull us off course? And your star is different depending on whether you're a Freedom Founder, Builder, Scaler, or Steward. Same sky, different destination. Without that North Star, every decision becomes a debate. With it, your priorities become obvious. This is what a BHAG really gives you, a single unifying objective. One thing everyone in your business can point to and say, that's where we're going. Not 17 priorities, not everything matters, one clear direction. And when your team knows the destination, they can make decisions without you. They can prioritize without endless meetings. They can say no to opportunities that don't serve the goal. Strategy stops being a mystery and becomes simple. What gets us closer to the North Star? Growth decisions become clearer, hiring decisions become clearer, investment decisions become clearer. You've created alignment without needing to control everything. That's the power of a well-defined BHAG that matches your pattern. So now, hopefully, you know your pattern. You understand you need a North Star, a BHAG that aligns with who you actually are. So how do you know when yours is right? Well, there's a critical piece we haven't touched on yet. It's a piece that too many founders never really figure out for themselves. Your BHAG tells you where you're going, but it doesn't tell you why that matters. Why should your team sacrifice for this goal? Why should you? What happens when you hit the BHAG and realize it didn't actually give you what you wanted? So that's what we're covering in the next episode. How to build a BHAG that works for your pattern and why your North Star needs to matter beyond just you. Pattern, BHAG, purpose. The three elements that I reckon transforms disconnected tactics into coherent strategy. And we'll pick this up next time. Thanks for watching. Thanks so much for listening to the show. Your ears are really important to me. If you haven't already, why not check out joshcomrie.com. There's a bunch of free resources on there, a downloadable chapter of my upcoming book, 2 commas, a diagnostic to help you understand where your business may be at in relation to your exit journey. And why not feel free to drop me an email with any feedback that you could have. Any way I and any of us can improve is through feedback. Thanks again for listening.